Hey guys, what's up? So we'll start with fiscal policy, the first video on fiscal policy today under Indian economy. So this is presented by me, that is Ayush Sanghi. So as you know that I am a chartered accountant and I have taught at various reputed CSE study circles. Here we are trying to impart high quality accessible education. You know the name of this education revolution, An Academy. Starting with fiscal policy. So in the last video under monetary policy, you came to know that first leg of public finance is known as monetary policy. The second leg is known as fiscal policy or policy with the Ministry of Finance, that is Government of India. So please remember this is the first basic difference between monetary and fiscal policy. Monetary policy is in the hands of the central bank of this country, that is RBI, and the fiscal policy is in the hands of Ministry of Finance, that is Government of India. So this is dealt with by the Finance Minister. It is a tool for general macroeconomic policy that seeks to influence the level of economic activity through two instruments. Remember these two instruments, they are very, very important. The only two tools through which fiscal policy can be modulated. The first one is government expenditure. This is also known as public expenditure. And the second is taxes. The taxes that you all come to hear about every day in everyday life. Taxes like income tax, wealth tax, gift tax, etc. We are going to discuss these taxes in the video, and these are also imposed by the government. Now, what is the objective of fiscal policy? Why is something like fiscal policy implemented? So the aim of fiscal policy is economic growth. How do we grow economically through fiscal policy? As you know that the government imposes taxes, all forms of taxes on the citizens of India, on the people of India, on the companies of India, on trust of India, on every person in India has to pay taxes. Through those taxes, the government spends on expenditures like defense, on expenditures like 5-year plans, missions, etc., etc. And all those missions, they give employment to people, they help us growing economically. So economic growth is the first primary important aspect with fiscal policy. Second, it stability of price. How does the government maintain price? Is through increasing or decreasing inflation. Please remember this. To modulate inflation, even the government of India has a tool in its hands by the name of fiscal policy. So it's not just monetary policy that is taking care of inflation, it's also the fiscal policy that looks after inflationary aspect. The other goals of fiscal policy are, as you can see, capital formation. This is the primary objective for developing economies, capital formation. Capital formation in terms of building hospitals, in terms of building schools, health centers, etc. All these are capital formation instances. As soon as the government imposes taxes, it can spend something on something like within capital formation. Second is allocation of resources. So as we discussed in our first video or in an introductory video about allocation of scarce resources, this can be done by the government of India primarily through the efficient fiscal policy that it adopts. And the third is redistribution of income for mitigating inequality. What do we mean by redistribution of income? The income that is deferred or that is different at every single level. A low income level group person would earn accordingly, middle income would earn a little higher, and high income group would earn the highest, which is why the names low, middle, and high. Now, the taxation structure of our country is progressive. So, the taxes charged are accordingly. The person who earns the least has to pay the least taxes. So, we redistribute the income. The person who earns the maximum income has to pay the highest tax. Highest tax over and above, he has to pay something like surcharge. This is known as redistribution of income, which reduces inequality in our country. Now, as we had discussed earlier, we have two instruments of fiscal policy. One is government expenditure and the other is taxes. Both these instruments can be given effect through two functions. Remember the two functions under fiscal policy. First is allocation function. Very, very important allocation function. How do we allot or how do we allocate goods? The expenditure done on public goods is known as the function that is allocation function. Any kind of allocation on public goods which is good for the public, which can be used for the public. For example, in national defense, army, navy, air force, general security, which is coming within Ministry of Home Affairs. So all this is considered for public good. Expenditure on building roads, national highways, government administration in short. So entire allocation of resources is coming under allocation function. The second is distribution function. How to distribute or how to come across proper mode or channel of distribution amongst the people. So government through its taxation policies, whatever it charges from people, it attempts to bring about fair distribution of income by collecting taxes. Therefore, it can alter the income distribution through affecting personal disposable income of people. Very, very important point, personal disposable income. There are three types of income that a person earns. First is known as income that we commonly call as CTC, cost to company. This is gross form of income. Second is what is takeaway or take away at home, what you actually get from your employer. And the third is personal disposable income, which is used for consumption plus savings. दो चीज़ों के लिए ये यूज़ होती है, कंजम्पशन प्लस सेविंग्स, जिसमें से आप टैक्सेस पे करने के बाद ये वर्ड लेकर आते हो डिस्पोजेबल. So after paying your personal income tax, whatever you are left with is known as personal disposable income. This personal disposable income can be reduced or it can be increased as per the fiscal policy adopted by the government. So if the government has adopted a strict fiscal policy or a stringent fiscal policy, the disposable aspect or the disposable part will go down as you will be charged higher taxes. On the other hand, if the government has adopted a cheap fiscal policy or a not so stringent fiscal policy, the disposable income will go up. And when the disposable income go up, you can spend more. So that is the distribution function with the government. Two objectives, twofold: allocation and distribution function. Please remember this, very, very important. Now, what is government expenditure that we had discussed lastly? What is government expenditure? Kya hota hai government expenditure? Any kind of expenditure that can be considered to be public expenditure. In short, expenditure on the public. किसी भी तरह का खर्चा जो कि जनरल पब्लिक पे होता है. Expenditure on general public. So public expenditure is of the following types. Extremely important, very, very important. Please consider these two types of expenditures under public expenditures: capital and revenue expenditure, plan and non-plan expenditure. By the way, public expenditure was asked in PT 2015 under monetary policy. So public expenditure is not a part of monetary policy, hence that option was wrong. Capital and revenue expenditures. What is capital expenditure? Capital, as the name suggests, wherever you read this word capital, it simply means that you are building anything that can be termed as long term. There is no particular definition of long term as per under economy, but as per Income Tax Act, long term means you are building something which will last for greater than 3 years. 3 साल से ज़्यादा कोई चीज़ यूज़ होती है. So whatever spending you are doing or whatever expenditure you are doing can be regarded as capital expenditure. So expenditure done on acquisition of land. If I have to build a post office, if I have to build a lab, if I have to build, say, mission on Mars satellite. So all these expenditures are considered to be capital expenditures because they are long-term assets. They would result in creation of physical or financial assets in case of government. So for the government, whatever is resulting in creation of physical assets is considered to be a capital expenditure. Second is reduction in financial liabilities. What do we mean by liabilities? Government has what kind of liabilities? Our government borrows from many sources. It takes loans. It takes loans from IMF, International Monetary Fund. It takes loans from the World Bank. It takes loans from various other institutions, Asian Development Bank. All these people provide loans to the government which become a financial burden or a debt on the government. In order to reduce that loan, government has to pay them back. These loans are of extremely high value, $1,000 million or $2,000 million. So the repayment of these financial liabilities can be considered to be capital expenditure. So expenditure is when the income with the government or when the money with the government is reducing or it is going out of the pocket, it is resulting into outflow of money. So either the government will be spending on creation of physical assets or repayment of financial liabilities. Examples are these include expenditure on acquisition of land, on building, machinery, equipment, investment in shares, government also invests in shares, and loans and advances by the central government to state and union territory governments, PSUs, and other parties. So latest example can be Air India. If the government gives a bailout package to Air India worth 30,000 crores, so automatically it can be said that government is incurring this capital expenditure in order to revive this entity or this PSU, Air India Limited. Air India Limited. The second type of expenditure is revenue expenditure. Whenever you hear the term revenue, just consider it has to be a day-to-day expenditure. Day-to-day expenditure. Aaye din ke kharche. Routine expenditure. So expenditures other than the creation of physical or financial assets, other than the creation of physical or financial assets by the central government are day-to-day expenditures. Expenses are incurred for normal functioning of the government, payment of salaries to MPs and MLAs, running of parliament, having sessions of Lok Sabha and Rajya Sabha. All these are day-to-day expenditures. You do not have a choice regarding all these expenditures. Maintenance of Rashtrapati Bhavan is a day-to-day expenditure which has to be done. Second is interest payments. If you take any kind of loan, taking of loan is a capital revenue, and repayment of loan amount, that is the principal amount of loan, is capital expenditure. But when you pay the interest on loan, ब्याज जब पे करा जाता है, interest on loan, it is considered to be a revenue expenditure. Be very, very clear on this. So first is when you repay the principal amount of loan, it is considered to be a capital expenditure. When you pay interest on that loan that had been taken earlier, it is considered to be a revenue expenditure. So this interest is considered to be servicing the debt. A more economic term that is used nowadays is debt is being serviced. Servicing the debt means you are paying interest on that loan and you are servicing that kind of loan. Interest payments. And the third is grants given to state governments and other parties. So grants given or bailout packages given. A grant was given when there were floods in Jhelum in the state of Jammu and Kashmir. Similarly, Telangana. Telangana, when it was divided into another state, some grants were given. Grants are those kind of funds which are given with no hope of recovery, which is why they are known as grants. You will never get them back. Loans are something that you will get back, but grants are something that you will never get back. So grants are given to state governments. It is also charging a kind of expenditure on the public exchequer. Hence, all these three types of examples are classified under revenue expenditures. The third form is, or the second point under the type of expenditure is planned expenditure or plan expenditure. As from the name it suggests, any kind of expenditure that has been mentioned in the central plans by the government. Earlier, they were the 5-year plans. Now, whatever they are going to come out with under Niti Aayog will be called as a plan expenditure. So, for the first time, if something like National Horticulture Mission is being launched, whatever expenditure will be done on National Horticulture Mission would be classified as planned expenditure. Similarly, all the expenditures, for example, in 2006, MGNREGS, National Rural Employment Guarantee Act had come out. Whatever expenditures were done on it were considered to be planned expenditures. So let's read the definition. Plan expenditure relates to expenditure on central plans, 5-year plans, and central assistance for state and UTs. Plan expenditure can be categorized under both capital as well as revenue expenditures, what we had just studied before this. Is also categorized as planned expenditures in budget economics. For example, irrigation and rural development, construction of roads and bridges, national highways, etc., electricity generation, building of dams, all these are planned expenditures. Just the opposite are the non-plan expenditures, something that you do not plan about. You cannot plan these expenditures because these expenditures are charged. Salaries of Supreme Court judges, salaries of High Court judges, pension of Supreme and High Court judges. By the way, please remember, pension of High Court judges and Supreme Court judges comes from the Consolidated Fund of India, whereas salaries of Supreme Court judges come from CFI, salaries of High Court judges come from CFS, important from PT, polity point of view. It covers a vast range of routine or general expenditure on economic and social services of the government. Main items of non-plan expenditure are again non-plan expenditure, something that has not been planned, something that has to be there. जो होना ही है, no choice. There is no choice by the government to plan these expenditures. This has to be done. Interest payments. If you have taken a loan, that has to be paid. Hence, it's non-planned. Defense services. You have to incur defense services. Army, Navy, Air Force, etc. Expenditure has to be done. Subsidies, something that was announced 10 years, 15 years, 20 years back. Ganga Action Plan 1986, MGNREGA 2006, National Food Security Act 2013. Whatever subsidies are given, they have to be given. There is no choice. Salaries, pensions that are given an example of High Court judges and Supreme Court judges. All these are non-planned expenditures. So what is the basic difference between plan and non-plan expenditure? Plan expenditure can be said to be such an expenditure which is mentioned in the government plans, as we had just discussed, and non-plans are only to service what has already been mentioned, where the government has no choice. Important notes regarding non-plan expenditure are expenditures like the following constitute maximum non-plan expenditures. First is interest payments, as we had just understood. Defense expenditure, again, we have understood this is committed expenditure in the sense that given the national security concerns, there exists little scope for drastic reduction. Hence, this has to be done. Subsidies, as you know that we are a welfare state, so subsidies. All these constitute the maximum amount of non-plan expenditures in our country. Opposite of expenditure is government revenue. Government revenue. So what is the major source of revenue of the government? As you all know, they are taxes. Taxes. Government revenue is classified into following two types: capital receipts and revenue receipts. Capital and revenue receipts. What are capital receipts? Again, the word capital, as we had discussed earlier, something that is long term. So what is long term? If capital expenditure meant creation of assets, you have created an asset, you have spent 1000 crores in creation of Jawaharlal Nehru Stadium, that is capital expenditure. Similarly, capital receipts, when you sell off, if you sell off that stadium to a private operator, let's say FIFA, for hosting a football World Cup, then whatever you will get will be considered to be capital receipt. So every receipt of government which creates liability or reduce financial assets are termed as capital receipts. So selling off a stadium is reduction of financial assets. It is considered to be a capital receipts. Auctioning of coal blocks, very important example. Coal is a asset, government's asset. So if we auction that coal block to, let's say, Jindal Steel or any other private developer, then whatever he will pay, it will form a part of capital receipt of the government. Lest, or it says which creates capital liability. So if we take a loan worth $1,000 million from ADB or from World Bank or from any other source, IMF, then that is considered to be again a capital receipt and it creates a liability. So creation of a liability results in capital receipts. Reduction in a liability results in capital expenditure. Differences are very, very important. So what forms the major items of capital receipts? First is loans. Loans raised by the government from the public, which are called as market borrowings. Second is borrowings by the government from the Reserve Bank and commercial banks and other financial institutions through the sale of T-bills or treasury bills, something that I would discuss in the upcoming lectures, what T-bills are. Third is loans received from foreign governmental institutions, international organizations, what we've discussed, World Bank, etc. So any kind of loan, understand, any kind of loan taken by the government, either from the RBI, foreign government, other organizations, public, is considered to be a capital receipts. By the way, what we borrow from the public are through issuing certain government securities, also known as G-SECs. They also result into capital receipts. Recoveries of loans granted by central government. So if the central government has given a loan to state government, Bihar, a A loan of 1,20,000 crore has been given to come out of a distress situation or flood like situation. What recovery of that loan would result into capital receipts. Other capital receipts are small savings, PO savings accounts, national savings certificates. All these are considered to be GSECs or government benefits. Second is provident fund, what we deposited with the government. So either our employer deposits, then that will be called as employer's provident fund, and second is what we deposit, public provident fund. This we'll discuss in Indian taxation regime. Nevertheless, provident fund results in capital receipts. Third is net receipts obtained from the sale of shares in public sector undertakings. This is known as disinvestment. So, if the government does not have money, it would disinvest its stake in ONGC, Oil and Natural Gas Corporation, from 100% to 90%. So, let's say it dilutes 10% of its shares and raises 10,000 crores. It is considered to be a capital receipt. A capital receipt. The second item is revenue receipt. So, as we had discussed, revenue expenditure, day to day expenditure, what is revenue receipts? Revenue receipts are the receipts of the government which are non redeemable. That is, they cannot be reclaimed from the government. एक बार चले गए तो चले गए, they cannot come back. So, these are of two types. More clarity would be by understanding the types. First is tax revenue, second is non tax revenue. Tax revenue, government takes two types of taxes from us. First is direct tax and the second is indirect tax. Direct tax is income tax. Indirect tax is excise, customs, GST impending. All these things are tax revenues. So they would result into creation of receipts for the government. They cannot be got back from the government. Hence it is said that it cannot be reclaimed from the government. So, what are tax revenues? Tax revenues consist of the proceeds of taxes and other duties levied by the central government. Taxes, as we had discussed, wealth tax, income tax, etc. Duties can be customs duty, excise duty, additional customs duty, special additional duty, anti dumping duty. There are hundreds of duties existing in this country. So tax revenues are an important concept or component of revenue receipts, comprise the following taxes. Now this is a very brief introduction of taxes. Rest purely the taxes would be understood when we do Indian taxation regime. First, the most popular type of tax is income tax that a person pays on his personal income, individual salaries and his income. Second is corporate tax, the tax paid on the income by the companies, firms and corporations. Excise duty, duty levied on manufacturing. उसके बाद है customs duty, duties levied on any kind of import or exports. Service tax is levied on services. I am providing you a service, but I am not charging anything from you. Hence, I will not be levied, or service tax will not be levied on me. But if I charge from teaching in some other study circle, I will be liable to pay service tax. उसके बाद है wealth tax. There was a proposal in Finance Act 2015 to abolish this. So wealth tax would no longer exist from next year onwards, but we have to wait for that. It is charged on the net wealth of the assessee. And lastly, the gift tax. So wealth tax, gift tax I have included, but they are not very important from the point of view of this kind of revenue. Only remember the names. The second type of revenue receipt is non-tax revenue. So it mainly consists of interest receipt. Central government granting a loan to state government. It would give interest in return. Interest milega. That kind of interest receipt is considered to be non-tax revenue. It is considered to be non-tax revenue on account of loans by the central government. Let's understand the differences. So if the central government is granting loan to state government, giving loan to state government, it will be considered to be a capital expenditure from the point of view of central government. Whatever the government will earn in form of interest, it will be considered to be a revenue receipt, particularly speaking, non-tax revenue receipt. On the other hand, if World Bank is giving loan to central government, it will be considered to be a capital receipt for the central government. When the central government pays interest to them, it will be considered to be a revenue expenditure. And when the central government will repay the loan back, it will be considered to be a capital expenditure. Similarly, here, if the state government repays the loan to the central government, it will be considered to be a capital receipt for the central government. All these are very basic concepts. Second part is dividends and profits on investment made by the government. Investment made by the government has 51% shares of NTPC Limited. So NTPC earns profit, the dividend is also earned by the government. That is considered to be its non-tax revenue. Fees and other receipts, services rendered by the government. सड़क पे आपका चालान कटता है. A traffic हवलदार, if he cuts your challan on over speeding or not wearing a seat belt, whatever fees he charges, that is also considered to be a revenue. And cash grant and aid from foreign countries. So if an earthquake occurs or any kind of mishappening occurs, or even if no mishappening occurs, whatever grant we are getting from any country abroad is considered to be a non-tax revenue. Basically, any revenue which is non-tax, no, which is sorry, any revenue which is other than taxation revenue will be categorized under non-tax revenue. Non-tax revenue. So this was it, part one of fiscal policy. Please be part of this education revolution initiative by Roman and Gaurav. I am a part of this for the past 2 or 3 videos, as you can see. Like, comment, and subscribe. You know the links. Hit thumbs up on Facebook. This is our Unacademy channel on Facebook, Roman's official channel. Unacademy channel on Twitter, Roman Saini's Twitter handle. Education for Revolution. Thank you for watching our tutorial.